There's this quiet revolution happening inside some of the world's biggest companies. The role of risk manager, which, let's be honest, was often seen as a roadblock, is being completely transformed into one of the most powerful, strategic jobs in the entire C-suite. We're going to explore how that happened. So, let's just start with a question that kind of flips this whole topic on its head. What if the biggest risk a company can take is actually playing it too safe? That idea is really the core of this entire new mindset. See, in today's market, avoiding risk doesn't just mean safety anymore. It can actually mean stagnation. The new goal is to use risk as a tool to find opportunities and drive real growth. Here's how we're going to break it all down. First, we'll take a look back at the old world of the risk gatekeeper. Then we'll track the rise of today's strategic risk leader. After that, we'll get into the technology that's making all this possible, the new way companies are organizing themselves for defense, and finally, what the future of oversight actually looks like. Let's jump in. All right, first up, let's take a quick trip back in time to the cost center era, just to really understand where we came from. In the old model, risk management was, well, it was like a ship with lookouts in every single room, but none of them were talking to each other. You had the finance team over here worried about credit risk, the operations team over there worried about market changes, all of them in total isolation. The focus was always on plugging the leaks you could already see, not on spotting the massive iceberg dead ahead. And the risk manager, that person was often known as the gatekeeper, or my personal favorite, the deal closer in chief. Their main job was to say no and to check a bunch of compliance boxes. And this created a culture where risk management wasn't a partner in success, it was seen as a roadblock to innovation. But of course, the pressures of globalization, tech disruption, and a wave of new regulations, well, they forced a change. And that brings us to the value creator revolution. Here's the change in a nutshell. It's night and day. We've gone from that siloed, department-level thinking to a truly integrated, company-wide view of risk. The entire posture has flipped from being short-term and reactive to long-term and proactive. It is a completely different ballgame. This table really breaks down the evolution of the Chief Risk Officer, or the CRO. Just look at the shift in focus. It's not just about minimizing losses anymore. It's about balancing risk with opportunity to actively create value. And check out the reporting line, moving from the CFO or COO all the way up to the CEO and the board. That's not just a tweak on an org chart. That is a massive shift in strategic importance. So how far ahead are these modern CROs looking? Not just next quarter, that's for sure. They are strategically anticipating market shifts 18 to 24 months into the future. That is the definition of playing offense instead of defense. And the scope of their responsibility has absolutely exploded. It's way beyond just financial risk now. Today's CRO has to worry about AI-powered cyber attacks, geopolitical shifts, ESG demands, fragile supply chains. They even have to think about the company's ability to attract and keep top talent. The job has gone from a deep specialist to a generalist who needs to be an expert in, well, pretty much everything. So you're probably wondering, how on earth does one person manage all of that? The short answer is, they don't. Not alone anyway. This whole revolution is being powered by an incredible new arsenal of technology, the modern enterprise risk management tech stack. The technology's journey perfectly mirrors the evolution of the role itself. It started with manual, error-prone spreadsheets. Then that gave way to these clunky, siloed software tools that couldn't talk to each other. And now, we're in the era of integrated platforms that unify the entire risk picture. And this leads us to the core technology here, the GRC platform. GRC stands for Governance, Risk, and Compliance, and you can really think of it as the company's central nervous system for risk. It's a single system that connects all the dots, giving leadership one unified, real-time view of the entire organization. And these platforms are incredibly powerful. They use automation for continuous monitoring. They use AI for predictive forecasting. By pulling in data from HR, finance, operations, you name it, and putting it into real-time dashboards, they handle all the tedious work. And this is key. It allows the human experts to stop being data crunchers and start being the strategic advisors they need to be. Okay, so we've got a new kind of leader, and we have this powerful new tech. But how do you actually structure the organization to make it all work? Well, that brings us to the new model for defense. The key to organizing for resilience is a simple but really powerful framework called the three lines model. It's designed to solve a classic corporate problem. When everyone is responsible for risk, it turns out no one is. This model makes it crystal clear exactly who does what. So here's the breakdown. The first line, that's your front line. The business teams who are out there making decisions and managing risk every single day, they own it. The second line is the enterprise risk management and compliance functions. They provide the tools and the oversight. And then the third line is internal audit, which gives that independent assurance that the whole system is working like it should.
And it is so vital to understand that the second and third lines are not rivals, they're partners. The ERM team is in the trenches, proactively helping the business. Then internal audit comes in and provides an independent check to make sure the whole system is sound. It's all about collaboration, not redundant oversight.
All of this fundamentally changes how oversight works at the highest levels. It's really about shifting the focus from looking in the rearview mirror to using a forward-looking radar. You can really see this philosophical shift just by looking at the questions being asked. A traditional audit asks a backward-looking question. Are we doing what we say we're doing? But a modern risk review asks a forward-looking one. What should we be doing to prevent future problems? It's the difference between checking for mistakes and building a system to avoid them in the first place. And this isn't just some corporate trend or a nice idea. It's actually being written into law. In the US, the Public Company Accounting Oversight Board, or PCOAB, is formalizing this proactive approach with a new standard called QC 1000, and it's making this mandatory for audit firms. And get this, there's a real deadline. The standard becomes effective at the end of 2025. This means it isn't some far-off concept. It's forcing firms right now to build what they call a continuous feedback loop for improvement, making proactive risk management the new regulated baseline. So let's just bring it all together. This revolution really does touch every single part of the business. The role has shifted from a reactive cost center to a proactive value creator. The technology has evolved from spreadsheets to AI-powered platforms. But I think the biggest change of all is cultural, moving from a simple compliance checklist mentality to a mindset of embedded accountability and awareness across the entire organization. Which leaves us with one final and I think pretty fascinating question. As AI gets better and better at monitoring and predicting, what is the role of the human expert? In this new world, is human judgment the ultimate risk that needs to be managed, or is it our greatest strategic asset? Something to think about. Thanks for joining me on this explainer.